The deal looked like progress on paper. Billions in promised investment. Thousands of projected jobs. A surge of optimism baked neatly into government press releases and corporate earnings calls. But somewhere between the signatures and the shipments, the money began to behave strangely. It didn't stay where it was supposed to. It moved quietly, efficiently, across borders and balance sheets, leaving behind a question that still lingers today: who really profited from Africa's biggest mining deals? At first glance, the numbers told a reassuring story. Export revenues climbed. GDP projections brightened. Analysts pointed to Africa as the next frontier of global growth. But beneath the surface, economists noticed something unsettling. Despite record mineral output, public budgets remained tight. Infrastructure stalled. Ordinary families living near extraction sites saw little change in their daily lives. The wealth was real, but its destination was not. Journalists began pulling at a loose thread hidden deep inside regulatory filings and offshore disclosures. Investors whispered about unusually structured contracts. Governments defended the deals as necessary compromises. Foreign markets watched closely, calculating exposure. And in quiet corporate offices, lawyers reread clauses that suddenly felt heavier than they had before. What do you think? Could a deal this large move this much money without leaving fingerprints? And if it happened here, could it happen in your country too? If stories like this fascinate you, subscribe and join us as we uncover the hidden mechanics of global finance. And tell us in the comments, what country are you watching from? The story begins far from the mines themselves, inside quiet government offices where fluorescent lights hum and contracts are signed without ceremony. In the early 2000s, as commodity prices climbed and China's industrial appetite surged, African governments found themselves courted by global mining giants. Copper, cobalt, gold, iron ore. Suddenly the ground beneath entire regions was revalued overnight. Ministers spoke of opportunity. Executives spoke of efficiency. The numbers, at least initially, seemed to agree. Early economic signals were promising but oddly restrained. Production forecasts rose sharply, yet projected tax revenues moved more slowly. Analysts noticed generous stabilization clauses buried in contracts, freezing tax terms for decades. Royalty rates were locked in at levels far below global averages. At the time, these concessions were framed as necessary incentives, the cost of attracting foreign capital into politically complex regions. Few questioned them publicly. Fewer still examined what they would mean long-term. For ordinary citizens near the mining zones, the shift felt abstract but hopeful. Roads were graded. Survey teams arrived. Security fences went up. Journalists captured images of ribbon cuttings and hard hats. But buried deep in the paperwork was a quieter discovery. Many of these deals routed ownership through offshore subsidiaries before a single shovel touched the ground. Profits, it turned out, already had an exit strategy. And once that realization surfaced, it raised a more troubling question. If the money was structured to leave from the start, what exactly was being built to stay? As the first shipments left African ports, the global financial system responded with enthusiasm. Commodity traders priced in long-term supply. Stock prices of parent companies lifted steadily. In London and Toronto, investors praised the discipline of risk-managed exposure. Yet on local balance sheets, the transformation was harder to see. Export values surged, but public revenue lines barely shifted. Economists began exchanging glances, a mix of curiosity and concern. The explanation sat hidden in layers of financial engineering. Transfer pricing arrangements quietly moved profits between subsidiaries. Management fees flowed outward. Loans issued from offshore affiliates generated interest payments that drained taxable income before it could be counted. None of this was illegal. All of it was meticulously planned. For corporations, it was optimization. For host countries, it was erosion, slow, technical, almost invisible. Governments responded defensively. Officials emphasized job creation and future upside. Some promised renegotiations once investments were recouped. But foreign markets were already adjusting expectations. Analysts downgraded revenue assumptions. Journalists began mapping corporate structures that spanned islands most citizens would never visit. And within those maps was a pattern that could no longer be ignored. The real profits were crystallizing far from the mines themselves. The question now wasn't whether value was being extracted, but whether anyone had noticed soon enough to stop what came next. The shift from optimism to unease didn't happen all at once. It arrived gradually in earnings reports that felt oddly restrained, in national budgets that failed to reflect record exports. By the mid-2010s, global commodity prices had peaked, and governments expected a windfall. Instead, finance ministers found themselves explaining why revenues were falling short. The minerals were leaving the ground faster than ever, yet public accounts told a thinner story. Investors began asking sharper questions. On trading floors in New York and Hong Kong, analysts traced cash flows rather than cargo ships. What they saw was unsettlingly consistent. Profits appeared to evaporate just before taxation. Entire mines reported years of losses, while parent companies posted healthy margins elsewhere. Economists warned of base erosion, but the mechanisms were so technical they struggled to capture public attention. For ordinary citizens, the consequences became tangible. Promised schools remained unfinished. Clinics lacked equipment. In mining towns, expectations quietly collapsed into frustration. Journalists interviewing local workers heard the same refrain: production was high but pay was stagnant. As these stories spread internationally, foreign markets recalibrated risk, and one uncomfortable realization settled in. The deals were working exactly as designed, just not for the countries that signed them. Governments moved under pressure, but cautiously. Some announced contract reviews. Others hinted at new mining codes or windfall taxes. The reaction from corporations was swift and measured. Executives warned of capital flight. Investor calls filled with carefully chosen language about regulatory uncertainty. Share prices wavered. Behind closed doors, lobbyists reappeared with revised forecasts and reminders of sunk costs. Foreign governments watched closely. Resource-dependent economies across Latin America and Asia studied Africa's experience like a case study unfolding in real time. Markets reacted not to moral arguments but to signals. Any suggestion of renegotiation triggered brief volatility. Currency traders adjusted positions. Analysts issued notes emphasizing that political risk, not geology, now shaped valuations. Meanwhile, the paper trail grew longer. Leaked documents, NGO reports, and investigative journalism connected dots that official audits never fully had. Each revelation added tension. The system was legal, global, and deeply embedded. Undoing it would mean confronting not just corporations, but the architecture of international finance itself. And as the world absorbed that reality, a heavier question emerged. If this is how value moves, what does ownership even mean anymore? With time, the story lost its urgency in headlines but gained weight in lived experience. The mines were still operating, trucks still carving red dust into long roads, ships still departing on schedule. Yet for many governments, the promised transformation never materialized. Budget shortfalls became normalized. Debt quietly replaced anticipated revenue. What was once framed as a temporary sacrifice began to look permanent. Analysts, looking back, described the outcome less as failure and more as design. The contracts had done what they were built to do: protect capital, stabilize returns, and minimize exposure. The surprise was not that profits left, but how predictably they did. Economists spoke more openly now, acknowledging that negotiating power had been asymmetrical from the beginning. Information, legal expertise, and leverage had all flowed in one direction. For ordinary citizens, the realization was deeply personal. The wealth beneath their feet had entered the global economy but not their lives. Journalists captured quieter scenes now: abandoned project sites, half-finished buildings, aging equipment still in use. The question was no longer who signed the deals, but whether the system itself allowed a different outcome at all. In the end, the paper trail told a story more honest than any press conference. It revealed a global economy where value is mobile, but responsibility is not. Where ownership exists more convincingly in spreadsheets than in soil. Where success is measured in shareholder returns, even when host nations are left negotiating what remains. Some countries have begun to respond differently. New contracts are shorter. Transparency demands are firmer. Regional cooperation is growing, slowly, cautiously. Investors, too, are adjusting, aware that public scrutiny has sharpened and reputational risk now travels as fast as capital. The system has not changed, but it has been noticed. And that may be the quiet truth at the heart of this story. Africa's biggest mining deals did generate enormous wealth. They reshaped supply chains, fueled industries, and enriched balance sheets across the world. But they also exposed a lesson that reaches far beyond mining. In global finance, profit is rarely accidental, and who benefits is almost never unclear. In the end, stories like this remind us that the global economy doesn't fail loudly. It succeeds quietly through clauses, structures, and decisions most people never see. The money moves as it was instructed to move, indifferent to borders, promises, or expectations. And for countries rich in resources but poor in leverage, The real battle isn't beneath the ground, it's on paper in rooms where signatures shape decades. Because long after the minerals are gone, the agreements remain, quietly defining who truly owned the wealth all along.